Right now, somewhere in Australia, a retiree is about to make a mistake that will cost them money. Not because they did anything wrong, not because they're careless, but because nobody told them what changed. In 3 days, the financial year closes. And this particular EOFY, 2026, is quietly different from every one before it. New deeming rates, new pension thresholds, new super caps, new tax brackets starting July 1st, and a wave of tax time scams specifically designed to look like they're from the ATO. If you're over 55, drawing a pension, part pension, or living off your own savings, what you do in the next few days could affect your income for the rest of the year. So before you file anything, or before you assume you don't need to, give me a few minutes. Here's something most retirees don't realize. There's no age in Australia where you automatically stop dealing with the tax system. 65 doesn't do it, 70 doesn't do it. Even people living entirely on the age pension can have obligations they don't know about and entitlements they're not claiming. The tax and pension systems are connected, but they're not the same system. One mistake or one missed update can quietly shrink your pension for the next 6 months without you ever being told why. That's the part that catches people off guard. Centrelink won't always call you to say, "This changed, you might be affected." You have to know to look. So we're going to walk through this calmly, in plain English, no jargon, no scare tactics. Just what's actually changing, what you should check before June 30th, and what's coming on July 1st that you'll want to plan around. This is the belief that trips up more retirees than almost anything else. I'm not working. I'm on the pension. Surely I don't need to deal with the ATO. Sometimes that's true. Often it isn't. Whether you need to lodge a tax return depends on your taxable income, not your age, and not your employment status. If you've got savings earning interest, shares paying dividends, a part-time job, rental income, or you've drawn down on an account-based pension, that can all count as assessable income. And here's the detail that surprises people. Even when your income sits above the tax-free threshold, you may still end up paying little or no tax because of an offset built specifically for people your age. It's called the Seniors and Pensioners Tax Offset, SAPTO for short. Most retirees have heard the name. Almost none have had it actually explained. SAPTO doesn't reduce your taxable income. It reduces the tax you actually owe directly, dollar for dollar, once you qualify. For many single retirees and couples, combined with the tax-free threshold, this means a meaningful slice of retirement income can be earned with little or no tax attached. But it's not automatic just because you're over 65. Eligibility depends on your income and whether you qualify for certain pensions or allowances. This is exactly the kind of detail that's easy to miss when you're filing quickly just to get it done. People who lodge in a rush sometimes miss offsets they were entitled to the whole time and only find out years later, if at all. So before you lodge, check whether SAPTO applies to you. It's one of the few places where 5 minutes of attention can directly change the number at the bottom of your return. Here's something that affected pensioners back in March, and it's still shaping payments right now, yet a surprising number of people don't fully understand what it did. Centrelink doesn't look at what your savings and investments actually earned. It assumes a rate, called a deeming rate, and calculates your income from that assumption, regardless of your real returns. In March 2026, those rates went up. The lower deeming rate rose to 1.25%, the upper rate to 3.25%, applying above thresholds of roughly $64,200 for singles and $106,200 for couples. Here's the part that matters. A higher deeming rate means Centrelink assumes you're earning more from your money, even if your bank account is paying you less than that. And if your assessed income goes up, your pension can quietly go down. The good news, this coincided with an increase to base pension rates, so for most people, it roughly balanced out. But roughly isn't exactly. If you've got a meaningful amount sitting in savings or term deposits, it's worth checking whether the deeming change shifted your actual payment more than the indexation increase covered. This is the kind of thing that happens quietly, in the background, with no announcement that lands in your letterbox saying, "This is why your payment changed." Now here's a number that surprises almost everyone who hears it for the first time. As of March 2026, a single homeowner can hold financial assets, savings, investments, super, up to roughly $321,500 and still receive the full age pension. Above that, the pension reduces gradually. For a single homeowner, the part pension cuts off entirely somewhere around $722,000 in assets. For homeowner couples, it's roughly $1,085,000. Why does this matter to you specifically? Because thresholds get indexed, adjusted periodically. Someone who was told 3 years ago, "You earn too much, don't bother applying," might now sit comfortably under the new threshold and qualify for a part pension they don't even know exists. This happens constantly. People assume an old answer is still the current answer. It usually isn't. Before this EOFY closes, if you've never checked or haven't checked in over a year, it's worth running the numbers again. Not because something is necessarily wrong, but because the goalposts moved and nobody sends a personal invitation when they do. This next one is the most overlooked benefit in the entire system, and I mean that. The Commonwealth Seniors Health Card. It's for self-funded retirees, people who don't qualify for the age pension because their income or assets sit above the pension thresholds. In 2026, the income thresholds for this card increased. That means people who were knocked back in previous years, people who simply assumed that's not for me, may now qualify for cheaper medicines, bulk billed services in some cases, and other concessions. The frustrating truth about this card is that almost nobody applies for it unprompted. It doesn't get the attention the age pension gets. Because it doesn't pay you an income, it reduces your costs instead. But over a year, cheaper prescriptions and medical costs add up to real money back in your pocket. If you're a self-funded retiree who assumed concessions weren't available to you, check again. The rules changed. Your answer might have changed with them. Now let's talk about action, the things genuinely worth doing before the financial year closes, not after. First, superannuation contributions. The concessional before-tax contribution cap for this financial year is $30,000. If you're still working part-time or you have funds available, a contribution before June 30th can reduce this year's taxable income while adding to your retirement savings. This needs to actually land in your funds account by the deadline, not just be requested. Leave it to the last day, and a processing delay can cost you the whole financial year. Second, charitable donations. A gift to a registered deductible gift recipient before June 30th is claimable this year. It won't transform your tax bill, but if you were planning to give anyway, timing it before the deadline means it counts now rather than next year. Third, and this is the one people skip because it feels like admin rather than action, review your asset and income position with Centrelink before July 1st. Small changes in how your finances are structured can shift your pension rate for the entire year ahead. This is genuinely one of the few moments where a short conversation with a financial advisor or a free financial counselor can be worth disproportionately more than the time it takes. Here's the part most retirees haven't heard yet, because it hasn't happened. It's coming. From July 1st, 2026, the tax rate on income between $18,201 and $45,000 drops from 16% to 15%. For most people, that's a modest saving, a few $100s across the year. But if you're still earning part-time income on top of a part pension, it's worth knowing your take-home position is about to shift slightly, even if nothing else about your situation changes. Superannuation caps are also rising. The after-tax, non-concessional contribution cap increases from $120,000 to $130,000. The general transfer balance cap, which limits how much you can move into a tax-free retirement pension account, rises from $2 million to $2.1 million. For most retirees, these numbers will simply never come up. But if you're in your late 50s or early 60s and still actively building your retirement balance, This is exactly the detail that's worth a conversation with a financial advisor. Because higher caps can mean a genuine opportunity to top up before you finish working, not just a footnote in a budget speech. I want to shift tone for a moment, because this matters more than almost everything else in this video. Tax time is the single biggest season for scams targeting older Australians. Messages claiming to be from the ATO about a refund, texts about a tax debt that needs urgent payment, calls claiming your tax file number has been compromised. The ATO will never ask you to pay a debt using gift cards, cryptocurrency, or direct bank transfer to a personal account. It will never threaten immediate arrest over the phone. It will never ask for your full bank login details by text message. If something arrives that feels urgent, frightening, or designed to make you act before you think, that feeling itself is the warning sign. Genuine government agencies are not in a hurry. Scammers are. When in doubt, don't click the link in the message. Open a browser yourself, search for the ATO or Services Australia directly, and check from there. That one habit alone protects more retirees than any antivirus software ever will. One more practical note before we close. Keep your income statements, receipts, superannuation records, and any Centrelink correspondence for at least 5 years. Not because you're expecting trouble, but because if a question ever comes up, having the paperwork turns a stressful phone call into a 5-minute conversation. And if your situation involves more than the basics, an investment property, shares with franking credits, a downsizer contribution, or anything that makes you pause and think, I'm not sure how this works, that's exactly the moment to bring in a registered tax agent or a financial advisor. Not because you can't understand it, because your time and peace of mind are worth more than guessing. This video has given you the general landscape. Your specific situation deserves a specific answer, and that's what professionals are there for. Here's what I want you to take from all of this. The tax and pension system doesn't update you. It updates itself, quietly, in the background, and assumes you'll come looking. Most people don't lose money to the ATO through some dramatic mistake. They lose it through silence, an offset they didn't know existed, a threshold that moved without anyone telling them, a card they assumed wasn't for them. The few minutes you've spent here are the opposite of that silence. Before this financial year closes, take one action. Check your asset position. Ask about SAPTO. Look into the senior's health card. Or simply book 10 minutes with someone qualified to look at your specific numbers. If this helped you see something you'd missed, that's exactly what it was built to do, and there's more like it waiting for you. Subscribe if you'd like to stay ahead of next year's changes too, because there will be more of them. There always are. Take care of your money the same way you'd take care of anything else that's taken a lifetime to build, quietly, carefully, and on time.